I've never seen before in my career. And I've talked a little bit about this, but it's worth mentioning to your listeners. Look, in my career, almost 36 years, I've never seen Wall Street or Main Street acquiesce to anything other than 5% of gold, of an asset, a portfolio rather, being in gold. And, and it was acquiescing at best. Fine, put 5% of your money in gold. Now, recently we've seen the chief investment officer of Morgan Stanley say, no, sell half your bonds and buy gold. Their new platform, according to him, is 60 stock, 20 bond, 20 gold. You got Michael Hartnett, the chief analyst for Bank of America, with this very, very, very expensive newsletter that goes directly to the institutional traders, like many thousands of dollars a year. He's saying, no, it's 25, 25, 25, 25, 25 gold, stock, bond, short-term treasuries, gold. You got Jeffrey Gundlach, the bond king, saying, no, Monday morning, 25% in gold is not overweight. And then the 6,600 part, that's Jeffries. They used to be a primary distributor for all the world's mints. And they said 6,600 is their next target, at least intermediary target, for where they expect gold to go before it takes a little bit of a breather. You have massive institutional money, traders and analysts and chief investment officers speaking to the most sophisticated traders in North America, saying 25% of your portfolio in gold is not too much. I mean, that's just insanity, if you ask me. Goldman Sachs said, if 5% of the money comes out of the bond market because they fear that there is no independence on the Fed anymore, that gold would go to 5,000 like that. Well, when you have Stephen Mirren sitting in the Fed, who it was Trump's advisor and the architect of the Mar-a-Lago Accord, he fills the vacated spot. What independence? The Fed has no independence. So gold is moving in that direction. You got Bank of America just saying $67 for silver is their target for next year. So when we talk about record highs around 4,400 gold and then it falling off and everyone saying it's over, I find it disingenuous at best when you have these analysts saying this. And here we are back up above $4,100, and that shows the strength and the underlying support. So gold's held up because of central bank accumulation. And to me, that's what we've been saying forever. We've seen physical demand rising and global monetary stress increasing, all of the stuff that we talk about. But what I believe we are seeing, kind of what we were just talking about, is a slow motion global run on physical gold. And the pullback from those highs wasn't a breakdown, it was a consolidation. Catching its breath, not throwing in the towel. Pick your euphemism. But the bottom line is gold isn't just strong, it's structurally more attractive than many people realize. And I think that the recent pause is the calm before the next leg higher. That I do believe. And maybe this is it here today as we're up over $100 as we're talking. So the awakening has started. My whole career, gold and silver were dismissed as relics. And, even when you try to get a bank account in the precious metals industry, at least for many years, you were lumped in with marijuana dispensaries, strip clubs, liquor stores, gambling, casinos, kind of thing where, it's very fringe and very speculative and dismissive at best. And I think that's all part of the game, to push everyone into a system that is dominated by Wall Street and paper promises. But now Costco and Walmart, to your point, sell bullion and even the media talks about dollar debasement. That's not normal. None of that is. That's all new. I would argue, to your point, we are in the early stages of a monetary reawakening because people feel something is broken. Most people feel it in their rising bills and their rent and their stagnant wages. And they may not understand fiat currency or macroeconomics. I try so hard to make this easy to understand. It's very hard when you use words like Triffin's dilemma or, Cantillon effect or rehypothecation. I mean, people don't get it. I try hard, but they do understand that they feel something is broken. And as trust in institutions continue to erode, you will see this shift accelerate because gold and silver aren't promises, they're real value. And I think the world is very slowly waking up to it. We're on a path towards sound money resistance, but that's at a much higher level. This is the level that we've been talking about earlier, the sovereign wealth funds, the commercial banks, central banks, they are aware of it. I think the U.S., the people that make the policies are keenly aware of it. The public isn't there yet. Yeah, you see some interest in Costco and Walmart, but if you look at the numbers, last I looked, in the U.S., you have the insiders on Wall Street leaving at a record clip. And and Warren Buffett with $500 billion in cash, and all the insiders selling, Jamie Dimon dumping stocks, Zuckerberg dumping stocks, Bezos selling $7 billion of Amazon, the big insiders and board members of Nvidia doing the same, institutional traders, selling $2 billion a week. At the same time, the public has its largest allocation to the stock market in history, over 54%. The largest amount of margin debt, 1.4 trillion. It went from 1 trillion to 1.4 like that. And also the largest exposure to options. So you have mom and pop all in on stocks, all in on margin, and all in on leverage with options. At the same time, the big money's moving away. At the same time, you're seeing massive deliveries on COMEX. Now, these are people that are incredibly sophisticated and are trading in billions upon billions upon billions upon billions of dollars every week or month into COMEX. I don't care what argument people want to make. The people at that level that are bringing in that kind of metal, they don't do things, pardon my French, for shits and giggles. They have all of the information. They know what's coming. And isn't it interesting that as we become a net exporter of gold, that gold, even with its pullback, is up north of 50% this year, an asset that pays no interest. But who's been accumulating it all? Not only the most well-funded traders in the world, the most well-informed. I've been screaming this. You can't look at the mainstream media and base your conclusions upon a faulty narrative where all of the media outlets are controlled by 4 companies. Instead, look at what the biggest money in the planet is doing. And yet, there has not been one mainstream news article about all the gold and silver coming into COMEX. I have yet to see anyone talk about it, or any Jim Cramer, or any of these so-called experts. Why isn't anyone saying, why has the United States imported billions upon billions upon billions? Oh, that's right, we've been doing that with silver too, and we did just reclassify it a critical mineral. Maybe the insiders knew what was coming.
It's funny. In almost 36 years of doing this, I've seen gold dismissed, ignored, laughed at, even outlawed in polite financial conversation. Wall Street would tolerate it the same way it tolerates a mosquito at a picnic. Annoying, but not worth swatting. If you were a portfolio manager who said, hey, maybe we should allocate 10% to gold, you'd get the same look you'd get if you told your boss you were investing the firm's pension fund in canned food and candles. The best you could ever get was 5%, and even that was an act of mercy. Fine, and they'd say, put 5% in gold if it makes you sleep better. That was the ceiling for decades, but something remarkable has changed. For the first time in my career, the same people who used to laugh at gold are now recommending it, and not just a token 5%. You've got the chief investment officer at Morgan Stanley saying, sell half your bonds and buy gold. Their new model portfolio is 60% stocks, 20% bonds, and 20% gold. Think about that. That's not a gold bug talking. That's Wall Street's institutional core saying gold is no longer an afterthought. It's a pillar. Then there's Michael Hartnett over at Bank of America. His institutional note, the one that costs thousands of dollars a year to access, tells professional traders to go 25% stocks, 25% bonds, 25% short-term treasuries, and 25% gold. A perfect quadrant. When the bond king himself, Jeffrey Gundlach, says 25% gold is not overweight, you know the tide has turned. The people who used to mock us are quietly building vaults of their own. And get this, 6,600, one of the world's biggest precious metals distributors, has just publicly said their next intermediate target for gold is $6,600 per ounce. Not $2,200, not $3,000, $6,600, and that's before they expect it to take a little breather. Even Goldman Sachs, the high church of fiat finance, has admitted that if just 5% of the bond market reallocates into gold, the price would rocket to $5,000 like that. Snap your fingers. Why? Because they understand what's happening. The perception of Fed independence is dead. When you've got Stephen Mirren, Trump's former economic advisor and the architect of the Mar-a-Lago Accord, now sitting inside the Fed itself, where's the independence? The fox isn't guarding the henhouse. He's rewriting the menu. And then you have Bank of America saying silver could hit $67 next year. 67. That's not a fringe YouTube forecast. That's one of the biggest banks in the world saying it. And yet when gold pulled back from 4,400 to 4,100, Every talking head on television screamed, "The bubble's over! Gold's finished!" Meanwhile, those same analysts have quietly been buying. This isn't a breakdown. It's a breather. It's consolidation. It's gold catching its breath before the next leg higher. You don't get 100 up days in a dead market. The pullback wasn't capitulation, it was digestion. And here we are again, gold pushing higher while the financial media pretends it doesn't see it. The truth is, gold isn't just strong, it's structurally superior. The foundation is shifting under everyone's feet. Physical demand is rising while trust in institutions is collapsing. Central banks, not Reddit traders, not newsletter subscribers, central banks, are buying more gold than at any point in modern history. That's not a coincidence. It's a slow-motion global run on real money. I'll tell you what it feels like. It feels like we're watching a monetary awakening. You can sense it. People don't necessarily understand the mechanics. They don't talk about the Triffin dilemma or the Cantillon effect or rehypothecation. But they feel that something is wrong. You can see it in their bills, their rent, their grocery cart, their stagnating paychecks. The average person might not know what fiat currency is, but they know that the dollar in their pocket buys less every month. And when trust breaks down, people reach for something real. That's why, for the first time ever, Costco and Walmart are selling gold bars. Let that sink in. You can buy frozen pizza, laundry detergent, and a 1-ounce gold bar at the same checkout counter. That's not normal. That's not a quirky retail trend. That's a signal.
Junk silver's not. It's not. It's dimes, quarters, and half dollars minted prior to 65. But where I say it's the best value, if you can do anything at or near spot, which junk silver is, or maybe a little over, but not much, you're buying something that is the best value with no opportunity cost, with no added premium attached. And you put that in reference or measure it against where it's been in the past. During the pandemic, because of its utility and its divisibility, the premiums were second only to American Eagles. And the U.S. Mint has been the model of inefficiency for a long time. And I asked people to listen to Bixweir's interview with, what's Jack's last name? I forgot Jack's last name. It'll come to me in a moment. But Jack Sermon developed the Silver Eagle program at the U.S. Mint, and Bix did a 3-part interview with him a couple of years ago. I remember almost falling off my chair, where he said he was approached by, at the time, his boss, which would have been the Secretary of Treasury, Janet Yellen, who told him to make as few Silver Eagles as possible without creating a global backlash. I mean, he actually said that the primary distributors came to him with far more demand than they could fill, like they wanted another 36 million and they gave him 12. And he said it really bothered him. So, there's a fine line between conspiracy and reality with the U.S. Mint. I would prefer Silver Eagles all day long, with many of these states looking at silver coins made in the U.S. as legal tender. But the premiums on Silver Eagles, on gold buffaloes, are crazy right now. And moving in that direction again. The fact that junk silver hasn't followed it the way that it did during the pandemic is testament to the fact that things aren't breaking apart for everyone to notice. This is just those who follow the U.S. Mint and their lack of capacity. But if I were going to say what is normally, I would say bars. But due to the threats all along this year of tariffs, the bar industry, or the products that are associated with silver bars, they're coming largely from Switzerland, and with Pam Swiss and Valcambi and others, they weren't imported very much. And so the premiums are higher on them than I like. Maybe 1-ounce rounds, those come from domestic refiners here, would be the next best. Or maybe even there are some coins like the 2026 Silver Kangaroo that we have in stock, or some of the other coins that are not American Eagles, but are of the other 6 major mints, the Krugerrands, the Britannias, the Philharmonics. They're right there. And because the bar market is inflated, I skip it. So it would either be junk silver, 1-ounce rounds, or coins from probably not even the Maple Leaf, which is getting inflated again. It would be South Africa, Australia, UK. To me, would probably be the 3 that would stick out as being a good value right now.
What impact does China restricting exports of silver mean for us and the LBMA?
Well, I think it means a lot for the LBMA. It because of this, and because the move to classify silver as a resource of national interest, that's China. And then you add the U.S. putting it on the critical mineral list, which means they too can curtail exports. The president can do it without congressional order. And then you look at the essential role of silver in solar panels, electric vehicles, semiconductors, defense, you name it.
This is what I've been saying for years. Gold and silver aren't relics. They're resistance. They're the monetary version of civil disobedience. They're how you opt out of a system built on lies, leverage, and credit creation. And that resistance is spreading. From sovereign wealth funds to central banks to Costco shoppers, everyone's starting to feel it. The institutions know, the policymakers know. They're just trying to manage the narrative long enough to position themselves before the public catches on. We're entering a phase where gold is no longer contrarian. It's becoming consensus, but for the wrong reasons. People aren't buying it because they want to diversify. They're buying it because they don't trust anything else. You see, when Wall Street recommends gold, it's not because they've become enlightened. It's because their models have broken. The old 60-40 portfolio, 60% equities, 40% bonds, doesn't work anymore. Bonds used to be the ballast. They paid yield when stocks fell. But now, with real yields negative and inflation persistent, bonds are no longer the safe haven they once were. So what fills that role? Gold. And not just for hedge funds or family offices. For the first time, institutional investors are treating gold like a core holding, not a hedge. That's revolutionary. But let's go back to what's happening behind the scenes. Because while the public watches the daily price tick, the real action is in the physical market. COMEX deliveries are soaring. Central banks are buying in record quantities. The LBMA vaults in London are bleeding metal. The Shanghai Gold Exchange is trading at premiums to spot. That's not speculative froth. That's structural shortage. When you see premiums on physical gold and silver persist for months, it tells you one thing. There's not enough to go around. And that's the essence of this entire story. The financial system has multiplied claims on gold far beyond the amount that actually exists. There are dozens of paper ounces for every real ounce. As long as confidence holds, the illusion works. But when confidence breaks, when people start asking for delivery, that's when the paper empire collapses. I call it a slow motion run on gold. It's not a panic, yet it's an awakening. Step by step, institution by institution, people are redeeming paper promises for real metal. And that's how monetary systems end. Quietly, then all at once. It's no coincidence that this awakening coincides with political and social breakdown. People don't need to be economists to feel betrayal. When your rent doubles, your savings lose purchasing power, and your leaders tell you inflation's under control, you know you're being lied to. That erosion of trust is the spark that ignites every currency reset in history. And here's what's fascinating. We're seeing this breakdown at every level of the hierarchy. The insiders, the billionaire class, the corporate boards, they're not buying the dip. They're selling into it. They're exiting their own companies while the public piles in with record leverage. That's the last chapter of every mania. The insiders see the writing on the wall. They know the era of cheap money is over. They know the Fed can't hike rates without blowing up the bond market and can't cut them without collapsing the currency. They know that no matter what, the outcome is the same. The purchasing power of fiat money will fall. So they're moving into real assets, quietly. Gold, silver, land, energy, infrastructure, anything tangible. Meanwhile, the average investor is doing the opposite. Buying tech stocks with margin debt, chasing AI narratives, and believing the lie that inflation is transitory. It's not transitory, it's terminal. And as this divergence widens, between what people are told and what the powerful are doing, gold becomes the bridge between illusion and reality. That's why I say we're witnessing the early stages of a monetary reawakening. People are starting to understand, consciously or not, that our entire financial system is built on trust. And that trust is gone. When you strip away the jargon, gold and silver are the only assets with zero counterparty risk. They're not a promise to pay, they're payment itself. Every other asset, stocks, bonds, derivatives, even bank deposits, depends on someone else's solvency. Gold doesn't, and that's why the physical market matters. When you take delivery, you're not just buying metal, you're opting out of a system you no longer trust. The irony is, the United States, once the greatest creditor nation on earth, is now a net importer of gold and silver. We're supposed to be exporting stability, not hoarding it. But the world sees what's happening. They see the deficits, the debt spiral, the political chaos. They know the dollar's days as the global reserve are numbered. That's why you're seeing gold flow from west to east, from New York and London to Shanghai and Dubai. The real money is moving eastward, following the gravitational pull of real production and real savings. I've said this before, and I'll say it again. Gold is not rising. It's the dollar that's falling. The chart doesn't show gold going up. It shows confidence going down. And silver? Silver is the fuse. It's the monetary nitroglycerin. It's a much smaller market, easier to squeeze, and once it catches fire, it moves like lightning. When Bank of America says 67 silver, they're not forecasting. They're confessing. They know there isn't enough metal to cover the claims. We're at the beginning of what historians will call the Great Revaluation, the moment when the world reprices real money against the backdrop of collapsing paper promises. So, what do? You prepare. You don't wait for permission from Wall Street. You don't wait for the headlines. You act before the crowd. You hold physical metal. You store it outside the banking system. You diversify globally. You reduce exposure to leverage and debt. Because when this next phase begins, there won't be time to react. The shelves will be empty, the premiums will be absurd, and the media will be asking, how did we not see this coming? Well, we did. We've been talking about it for years. Gold is not just an investment, it's the insurance policy against the arrogance of central bankers and the blindness of politicians. And it's finally being recognized for what it's always been, truth in a world built on lies. So when you see the price fluctuate, don't think in dollars, think in time. Every ounce you hold is time you've bought back from a system that steals it through inflation. Every coin is a claim on freedom in an age of control. And make no mistake, the awakening has begun.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.